Welcome to the deep dive. We're your shortcut to, well, getting smart quickly. We filter out the noise so you don't have to. If you want to be genuinely informed without drowning in data, yeah, you're definitely in the right place. Today, we're tackling a big one. Money, personal finance, managing your wealth, all that stuff that often feels uh, overly complicated. Most of us think financial success is all about being brilliant with numbers, right? Technical know-how. But the source we're diving into today, it flips that idea completely on its head. We're pulling insights from Morgan Housel's book, The Psychology of Money. And our mission here is pretty straightforward. We want to extract the core, maybe surprising, realization from it, which is that winning with money is less about how smart you are and way, way more about how you act.
That's right. The standard view, the one we're all sort of taught, treats finance like it's physics or something. You put in the right inputs, complex models, maybe an advanced degree, and you expect predictable, optimal outputs. We're always searching for that perfect formula. But here's the kicker, the big aha moment we're unpacking. Housel argues pretty strongly that your financial results, good or bad, they're overwhelmingly driven by your behavior and your emotions, your underlying mindset about money. It's not really about your IQ score or how good you are at calculus. It's basically behavioral science wearing a finance disguise.
Wow, okay. That really reframes everything, doesn't it? If that's true. It means like the super smart economist who gets spooked in a crash and sells everything,
Uh-huh.
they could end up worse off than, say, a janitor who just quietly puts money into their retirement account every single month for decades.
That's exactly the kind of scenario the book highlights.
But wait, is the book really saying that technical knowledge, understanding inflation or taxes, just doesn't matter at all? That feels like a bit of a stretch. Let's dig into that. Why does behavior supposedly beat brains when it comes to cash?
Yeah, good question. It's not saying knowledge is worthless, not at all, but it's pointing out its limits when, reality hits. If you treat finance purely like physics, you expect logic to rule. Buy low, sell high, let compounding do its thing. Simple on paper. The problem, though, is that markets aren't labs. They're full of humans, and humans under pressure. We don't always act logically. We get stressed, we get greedy, we get scared. And what's really fascinating is seeing how often high financial intelligence actually fails right when it's needed most, like during a market panic or a crazy bubble.
Okay, so the smarts are there, but something goes wrong in the application. Can you give a more specific example? Beyond just panic selling.
Sure, think about common cognitive biases, like anchoring. An intelligent investor might look at a stock and know mathematically it's way overpriced right now, but maybe they bought it years ago for like half the current price. They get anchored to that original price in their head. So even though their brain says this is too expensive now, their gut, anchored to the past, makes them hesitate or make a bad call. Exactly. Their intelligence gets overridden by that psychological anchor. Or take confirmation bias, the brilliant analyst who only looks for data that confirms what they already believe. They might miss huge warning signs. Over the long run, someone with maybe average smarts, but who sticks to a simple, diversified, hands-off plan, they often do better. It's less about complex models and more about temperament, discipline. It's a behavioral game.
That really clicks. So the biggest advantage isn't some secret formula, it's knowing your own psychological weak spots and, well, managing them. Okay, let's shift to what the book does emphasize positively. First up, behaviors. Simple, consistent actions. We're often looking for that complex edge, the perfect timing, the killer investment. But Housel keeps coming back to just routine. What does that tell us?
It suggests that the real power isn't in hitting a home run once. It's in the small, steady actions you take over and over again. Those habits, that consistency, they're like the engine driving wealth creation. Finding that one magic stock, that's kind of like trying to win the lottery.
Yeah.
Building good financial habits, that's building a reliable machine.
So things like saving regularly, investing consistently.
Precisely. Think about compounding interest. We all hear about it, right? Einstein supposedly called it the eighth wonder of the world. But here's the thing. Compound interest needs fuel, and that fuels compound behavior. You need to know about compounding, sure, but you also need the discipline to keep investing.
And crucially, just leave it alone, not tinker constantly.
Exactly. Don't mess with it. It's about endurance, not short bursts of brilliance or intensity.
Like dollar cost averaging, putting in the same amount regularly no matter what.
Perfect example. That's a
Yep.
purely behavioral strategy. You invest, say, $500 every month, whether the market's soaring or crashing. Now, on any single day, could you theoretically find a smarter entry point? Maybe. But behaviorally, DCA takes the emotion out. It stops you from trying to time the market.
Which almost nobody can do successfully anyway, right?
Statistically, yeah, it's incredibly difficult. So the real skill isn't predicting the market. It's maintaining that routine month after month, year after year, especially when the news is screaming doom or telling you to chase the latest hot trend. That takes humility, patience. Over
Yeah.
decades, that steady consistency just demolishes short-term intensity.
Okay, so behavior builds the structure, but you said we're human, which brings us to the really juicy stuff, emotions and mindsets. How do these deeper things, fear, greed, our fundamental beliefs about money, manage to break even the most disciplined behavioral plan?
This is where it gets tricky. Behavior is what you do, but emotions are the pressure points that can make you deviate. And mindsets, they're like the foundation everything's built on. The book really stresses that big external events, a crash, losing your job, even a sudden windfall, they don't cause failure on their own. They just reveal the cracks that were already there in your emotional and psychological makeup.
Like fear making you sell low.
Classic example. Fear turns a temporary paper loss into a permanent real loss because you lock it in at the bottom. And the flip side is greed, or maybe FOMO, fear of missing out. That feeling pushes people into bubbles, right? Buying stuff at crazy high prices just because everyone else seems to be getting rich. Your rational brain might see the danger, but the emotion is powerful.
Yeah, watching your neighbor brag about some crypto coin mooning while your boring index fund just plods along. That's tough emotionally, even if you know the index fund is the smarter long-term play.
Absolutely. That smart person, the one who understands risk on paper. If they let that euphoria or FOMO take over and start making highly leveraged, risky bets, well, they're essentially letting an emotion veto their own intelligence. The logical brain knows better, but the emotional brain wants that quick hit or wants to avoid feeling left out.
Okay, let's go even deeper. The third element you mentioned, mindsets. These sound like really ingrained beliefs. How do they act like filters on everything we do financially?
Mindsets are maybe the most powerful force and often the one we're least aware of. They're the stories we tell ourselves about money, often picked up from childhood or maybe from an early big win or loss. Let's take a few examples. First, the scarcity mindset. Maybe you grew up with very little money. Now, even if you earn a great income, that deep-seated feeling of scarcity might make you believe cash is the only truly safe thing.
So you hoard cash, even though inflation is eating away at it.
Exactly. You see inflation news, and it just reinforces your fear. You underinvest in things that could grow your wealth long term, all because of that emotional need for the feeling of safety that cash gives you.
That's fascinating. Your behavior feels rational to you based on your internal mindset, but from an objective financial perspective, it's holding you back.
Precisely. Or think about comparative wealth. We humans are social creatures, right? We look around. If your mindset is constantly comparing your financial situation to your friends, your neighbors, the people on Instagram,
Uh-oh, keeping up with the Joneses.
you got it. Lifestyle creep. You get a raise, and instead of saving more, your spending just inflates to match, maybe even exceed it, because you feel you have to maintain a certain image relative to others.
So again, intelligence might get you the bigger paycheck, but the mindset undermines the benefit by driving spending behavior.
It's a classic trap. And one more, experiential bias. Let's say you got lucky 20 years ago, made a killing on one particular type of investment. Your mindset might convince you that your success was all skill, not luck, or just being in the right place at the right time.
So you stick to that one thing, even when conditions change.
Right. You resist diversification. You ignore new information that contradicts your past experience. You overconcentrate. And when that one sector eventually turns, well, it can be disastrous. These mindsets, scarcity, comparison, experiential bias, they color everything. They filter the data. You can have the smartest plan written down. But if your underlying belief is money is hard to keep or I always need the next big score, you'll likely find ways, consciously or not, to sabotage your own plan through your actions.
Okay, so pulling this all together for you listening, what does it mean? We didn't just summarize an economics text. We've really dived into human nature, just using finance as the lens. The big takeaway from Housel seems crystal clear. Being financially literate isn't enough. If you're not also psychologically literate, you need both. So to really hammer it home, the game changer isn't finding some high IQ investment secret. Financial success hinges on mastering your own stuff, your behavior, emotions, and mindset. That shift in focus from external markets to your internal world, that seems to be the absolute key for long-term success.
Yeah, connecting it to the bigger picture. The book really encourages us to maybe redirect some of that energy we spend hunting for the next complex financial hack. You know, the fancy derivatives, the clever tax loophole, maybe stop searching out there and look in here at our own internal operating system. Because often, success really just comes down to doing simple, boring things consistently over long stretches of time. And crucially, managing not to blow yourself up when things get stressful, which leads to a really important question for you to chew on. If intelligence isn't the main driver, how much of your own financial plan is truly built on reliable, repeatable behavior? That simple commitment to routine versus how much is based on complex analysis that maybe changes all the time or gets thrown out the window during the first sign of trouble. What really determines your outcomes? Is it the brilliant strategy you designed or what you actually did the last time you felt financial fear or greed?
That's the perfect place to leave it. Since the book argues outcomes are so tied to these non-intellectual factors, here's something to think about. What's one single, simple financial rule? Maybe about patience, maybe about consistency, just a pure behavioral choice that costs nothing, that could fundamentally improve your long-term results no matter what the markets do. Just one behavior change. Maybe it's automating a savings transfer so you don't have to think about it. Maybe it's committing to not checking your portfolio every single day. What would that be for you? Because according to this, that's where the real leverage is. Think on that. Apply that behavioral lens to whatever you're learning next. We'll catch you on the next deep dive.